Welcome to Talk Tickers. We cut through the noise of earnings calls to bring you the essential insights.
And today, we're diving into Constellation Energy's first quarter.
Let's jump right in. What are the headline numbers?
Okay, so GAAP earnings were $0.38 per share. But the adjusted operating earnings, which gives a clearer operational picture, came in at $2.14 per share.
$2.14. How does that stack up against last year?
It's a solid increase. That's $0.32 higher than Q1 of 2023.
Nice. And are they sticking with their full year guidance?
They are. Reaffirmed the range of $8.90 to $9.60 per share for operating EPS.
And operationally, how did the power plants perform?
Really strong, especially nuclear. They hit a 94.1% capacity factor. That's pretty exceptional.
Okay, so solid numbers, strong operations. Let's unpack what's driving this. Management sounded pretty positive about the market right now.
Extremely positive. They're seeing a very favorable environment. A lot of it is driven by big tech.
The AI effect again.
Yeah. Exactly. Increased capital spending, big growth strategies around AI. It's really reinforcing the value of nuclear power.
And it makes their move for CalPine look even more strategic, I suppose.
Precisely. It underlines the logic there. They see this huge surge in demand coming.
Are they buying into all the hype around AI demand, though? Some of those forecasts seem wild.
They were careful about that. They acknowledged some forecasts might be overstated.
Okay.
But even taking a, let's say, more rational view, there's still ample opportunity for Constellation to support all this data center development. It's a significant wave.
And building new power generation to meet that wave?
Yeah.
That's not easy these days, is it?
No, not at all. That's a key point they emphasized. The cost of new entry, whether it's combined cycle gas plant or solar plus storage,
It's gone up.
significantly.
Yeah.
Both in price and just the time it takes to actually build and get online.
Which makes Constellation's existing fleet
Much more valuable. They've got clean, reliable assets ready to go. It's a huge advantage right now. Clean, reliable, and increasingly cost competitive.
You mentioned data centers. Are they actually making progress signing deals with these data economy customers?
They said they're making tremendous progress. Didn't give specifics, obviously, for competitive reasons.
Understandable.
But the tone suggests their pitch clean, reliable, price certain power is definitely landing well.
Okay, let's talk delivery. On-grid versus behind-the-meter connections. Can you break that down for us? What's the trend?
Sure. So think of on-grid as just plugging into the main power highway. Behind the meter is like building a direct private road from the power plant to the customer.
Got it.
And what seems to be happening is, behind the meter sounds great for control and maybe security, especially for huge users.
Got it.
But the regulatory side, getting approvals, coordinating with utilities, it can be complex and slow things down.
So on-grid is becoming more attractive.
Increasingly, yes.
Yeah.
Especially as utilities seem to be speeding up their interconnection processes a bit. Makes things easier.
Does that mean behind the meter is off the table?
Oh, not at all. For the really massive data centers, maybe ones tied to national security, that dedicated setup might still be the way to go. You might even see hybrid models.
Right.
Constellation also mentioned wanting clearer rules from FERC on behind the meter stuff, to help innovation.
Makes sense. Let's circle back to CalPine. How does this current market environment make that deal look?
It looks increasingly valuable. Like we said, building new gas plants is expensive and slow.
So buying existing ones.
Exactly. Acquiring CalPine's fleet gives them immediate scale and flexibility at what they clearly think is a good price compared to building new.
And the deal itself is proceeding okay.
Seems so. Yeah. Integration teams are ready. All the regulatory filings are in. They did get a deficiency notice from FERC and a second request from the DOJ, but they've responded. Still targeting a close by the end of the year.
Okay. They also mentioned their stock price and buybacks.
Yeah, management feels the stock isn't reflecting the full value of the opportunities they see, especially with this data center demand.
So they plan to buy back shares.
They do. They paused buybacks in Q1 because they had material non-public info related to the deal.
Right, standard procedure.
But they expect to resume. They've still got about $1 billion left on their authorization.
Okay, let's dig a bit deeper on that data center demand. You mentioned they're cautious about some forecasts being inflated.
Right. There's a sense that excitement is high, maybe too high in some projections.
Why the caution?
Well, one issue is that the same potential project might pop up in interconnection queues in multiple regions, developers hedging their bets,
So it looks like more demand than there actually is, potentially.
Potentially, yeah.
Yeah.
And historically, utilities have sometimes overshot their long-term demand forecasts. So a little realism is probably healthy.
And comparing the cost of generation, how does nuclear stack up now against new gas or renewables plus storage?
It's looking really good, actually. With the cost increases for new CCGTs and solar plus storage, nuclear is definitely cost competitive.
Yeah.
Maybe even winning across the board when you factor in reliability and predictability.
And they can offer long-term price certainty.
That's a huge selling point.
Yeah.
They mentioned offering 20-year fixed price contracts. You just can't get that with gas or renewables because of fuel volatility and intermittency.
What about managing the grid itself? They mentioned demand response.
Yeah, the idea is that the competitive market will find ways to adapt. Demand response, basically paying big users to cut back during peak hours, is expected to make a comeback as capacity markets get sorted out.
And the grid isn't running at full tilt all the time anyway.
And not even close. For most hours of the year, there's a ton of unused capacity on the grid.
So even small reductions during peak times.
Exactly. Even a modest peak reduction, say 25%, could potentially accommodate a lot of this new data center load without massive new infrastructure everywhere.
Right.
Plus, the EPA relaxed some rules on backup generators at data centers, which helps grid coordination.
So boiling it down, what are Constellation's big advantages right now?
Okay, number one, existing clean megawatts.
Yeah.
They have them now. Speed, yes. Price certainty with those long-term contracts. They can work pretty much anywhere on the grid.
Right.
Potential for more megawatts through restarts like Crane, life extensions, upgrades. The CalPine deal gives them that coast-to-coast capability. And don't forget the investment-grade balance sheet. Financial muscle.
Okay. Let's quickly hit some other financial points from the quarter. Commercial business.
Performed really well. Colder winter helped, but also good portfolio positioning, effective trading.
And margins.
Locked-in margins are looking strong, above the 10-year average. That gives good visibility for 2025 and beyond.
Anything else notable on the revenue side?
They got higher prices for Illinois, ZEC, and CMC programs. That was partly offset by lower nuclear PTCs booked in Q1, though.
Why lower PTCs?
Because power prices are now expected to be higher for the rest of the year.
Mm-hmm.
So high, in fact, that they expect to be above the PTC price floor across the whole fleet.
So they won't actually get the credits if prices stay high.
Right, which is, a good problem to have in a way. It means they're earning more from the market.
Makes sense. And nuclear operations, besides the capacity factor.
Still industry leading on refueling outages.
Yeah.
Averaging just 24 days. That's incredibly efficient.
Wow. And the Crane restart.
Progressing well.
Mm-hmm.
They mentioned over 11,150 new nuclear megawatts, including Crane, got chosen for accelerated PJM interconnection. Staffing for the restart is going well, maybe even ahead of schedule and under budget.
Good news there. Customer retention.
Strong renewal rates with both electric and gas customers.
What about the broader economy? Recession risks still feel like they're out there. How are they thinking about that?
They acknowledged it's a possibility, a temporary slowdown, maybe lower overall power demand. But they think that's likely offset by this data economy growth, plus general electrification trends, onshoring.
And the nuclear PTC helps there too, right?
Absolutely. It acts as a buffer if power prices were to tank in a recession. Provides downside protection. They also sounded confident about managing things like lower retail volumes or bad debt if a downturn did hit.
Any worries about tariffs impacting costs?
Not really. They estimated a negligible impact on O&M and maybe 1 to 2% on CapEx, including fuel, for 25 and 26. So pretty minimal.
Let's talk more about that nuclear production tax credit. It seems really important.
It absolutely is. And there was some good news there, too. The inflation adjustment for 2025 looks like it'll be higher than they first assumed. Maybe 2.3% to 2.6% instead of 2%.
What does that translate to financially?
It means the step up in the credit value happens a bit faster. The estimated adds about $500 million in incremental revenue to their base earnings by 2028.
Significant. And will they have enough tax liability to actually use all these credits, especially after buying CalPine?
They think so. Post-CalPine, they expect to have sufficient tax capacity. They even mentioned they might be in a position to buy tax credits from others if it makes sense.
And politically, the support for these credits seems solid.
Very strong bipartisan support in Congress for nuclear tax credits. Seems pretty secure long-term.
How are the actual negotiations going with these potential long-term data center customers? Does the regulatory uncertainty around behind the meter hold things up?
They said discussions are progressing well, actually. Customers seem to be actively looking at on-grid solutions now, given the complexities we talked about.
But still interested in behind the meter if the rules get clearer.
Exactly. They're exploring both paths. And importantly, those interconnection study timelines with the grid operators seem to be improving, moving from years down to potentially months in some cases. That helps accelerate deals.
Any more color on the type of data center demand? Is it mostly training AI models or running them?
The view seems to be that most of the load, at least near term, is for inference actually running the AI applications day to day. But these inference facilities are also getting much bigger.
And location decisions are shifting.
It seems power availability and how fast you can connect are becoming paramount. Maybe more important now than being close to population centers or existing fiber lines.
Interesting. So we might see data centers popping up in new places.
Could be. There's also a feeling that some of the really massive, like 7 to 10 gigawatt campus plans you hear about might get rationalized a bit, maybe broken up or scaled back.
And no pushback in places like Illinois against these huge power draws.
Apparently not specifically. It seems location decisions there are mostly driven by where it's easiest and fastest to get interconnected to the grid.
Okay, so wrapping up the core discussion for investors listening, what are the big takeaways from Constellation's Q1?
All right, key points. 1, strong Q1 results backing up the value of their nuclear fleet. 2, a really favorable market outlook thanks to AI demand and the high cost of building new generation. That positions them well for growth and long-term contracts.
Got it.
3, the CalPine deal looks strategically sound, adding scale and flexibility. And 4, that nuclear PTC is a major financial plus, providing revenue support and an inflation hedge.
Great summary. Okay, let's shift gears. It's time for our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on today's deep dive. What are you thinking?
Okay, here's one. We heard a lot about the need for reliable power, the focus on on-grid solutions, and maybe the return of demand response. So, what if the real bottleneck isn't generation, but transmission?
Go on.
Consider a speculative long position in companies working on advanced transmission tech. Think next-gen high-capacity lines, stuff that reduces power loss, or maybe innovative ways to upgrade the existing grid quickly.
So investing in the power highways, not just the power plants.
Exactly. If moving all this new clean power to where the data centers need it becomes the main challenge, companies that solve that problem could see, well, potentially exponential growth. It's about enabling the whole system.
That's definitely thinking outside the box, focusing on the grid infrastructure itself. Interesting angle.
Plausible, right? If maybe a little outrageous today.
Definitely plausible.
Okay.
Okay, remember everyone, that's purely hypothetical. It's just food for thought. Absolutely not financial advice. Always do your own research.
Thorough research.
We'd love to know what your key takeaways were from the Constellation call. Let us know your thoughts.
Thanks for tuning in to Talk Tickers. We'll be back soon with another earnings deep dive.